You're a high-earning executive or business leader, and by now you've probably realized that your income is about a lot more than just your paycheck. Equity compensation can be one of the most powerful wealth-building tools available if you understand how to use it strategically. But here's the problem. Most professionals don't. They get handed a grant of stock options or RSUs and feel excited in the moment, only to end up overwhelmed by tax surprises, fine print, or fear of making the wrong move. Maybe that's you. Maybe you've got a grant sitting in your HR portal right now, and you're not even sure what it's worth or what taxes you'll owe when it vests. And without a plan, you risk leaving big value on the table, or worse, triggering a tax bill that you never even expected. I'm Dan Pascone, founder of Tailored Wealth, and we help executives and business leaders to optimize wealth. And that starts with making equity compensation work for you, not against you. Before we dive in, I want to make sure that you have access to our full equity compensation white paper. It breaks down these concepts in detail and includes planning checklists, tax strategies, and grant negotiation tips. And you can grab it for free using the link below this video. All right, let's talk about what you actually need to know about equity compensation. Equity compensation is non-cash pay that gives you some form of ownership or exposure to your company's success. That could be stock options, RSUs, ESPPs, SARs, phantom stock, or performance shares. Companies use equity to preserve cash, retain top talent, and align incentives. If you're an early stage startup, you might get options. If you're a public company, it's likely RSUs or ESPPs. Now let's break down the most common types and what to look out for. ISOs or incentive stock options are available only to employees. They can qualify for long-term capital gains tax if you hold them for at least 1 year after exercise and 2 years after grant. But watch out for the AMT, the alternative minimum tax. We've seen executives blindsided by AMT because they don't model their exercise strategy carefully. NSOs are non-qualified stock options, and they can go to employees, contractors, or board members. They're taxed as ordinary income at time of exercise, which can lead to a big surprise if you're not ready. You may also owe payroll taxes, and if you hold after exercising, future gains could qualify for long-term capital gains if planned properly. RSUs are restricted stock units and are probably the most common award at public companies. They're simple. You receive actual shares once they vest, and you pay ordinary income tax on the value at vesting, not when you sell. That's where people get tripped up. You could owe taxes on a stock worth $100K today, but if it drops to $60K before you sell, you're still taxed on $100K. That's why same-day sales strategies are often wise. Performance shares are often used for executives and require that the company hits performance goals to vest. SARs or phantom stock provide cash value based on stock performance, but no actual equity in the company. And then there's ESPP, the Employee Stock Purchase Plan. You buy shares at a discount using payroll deductions. And if your company offers a look-back feature, you often get the stock at the lower of 2 different price dates, often done on a quarterly basis. That can boost your returns significantly, but the holding period is really important for taxes. Now, let's talk Lifecycle. Every equity award goes through a few phases. Grant, which is when you receive the award. Vesting, which is usually done over 3 to 4 years, sometimes with what's called a 1-year cliff. Exercise or release. With options, you choose when to exercise. With RSUs, it's automatic. And sale. This is when you finally realize the value. And the tax strategy is different at every stage. Here are a few pro tips. Exercise ISOs during low income years to reduce AMT impact. Use sell to cover with NSOs to handle withholding. Sell RSUs immediately if you want to minimize downside risk. And for ESPPs, plan your holding period to get capital gains treatment. But here's where most people miss the mark. They don't integrate equity into their broader financial plan. And they let their company's stock grow to 30, 40, even 50% of their overall net worth without realizing the risk. We generally recommend capping your concentrated stock exposure to 10 to 20% of your overall net worth. Use gains from your company's stock to fund other priorities, like building a diversified portfolio, funding a new business, or creating passive income streams. Let me give you a quick example. One client recently came to us with 500,000 invested ISOs. They hadn't exercised a single share because they were afraid of the tax hit. We built a phased exercise plan that minimized AMT, captured gains over multiple tax years, and converted equity into a diversified investment plan. That shift allowed this executive to step into a new role and buy a vacation home, not because they were guessing, but because they had a strategy. And that's what equity compensation should do: create options, not stress. If you're reviewing an offer, negotiating a package, or thinking about your next move, this stuff matters. Ask the right questions. What happens if I leave before my equity fully vests? How long do I have to exercise my options after leaving? Can I early exercise or get an 83B election? If you're granted stock options that allow for early exercise, you might be eligible for an 83B election. This means that you choose to pay taxes on the shares now at the low value rather than later when the shares have likely appreciated. It can be a powerful move to start the long-term capital gains clock early and reduce future tax liability. But there are risks, so make sure you consult with a professional before filing. These questions can save you thousands and reshape your entire comp trajectory. And if you're a founder or business owner issuing equity, get strategic about how it impacts hiring, retention, and liquidity. Equity compensation isn't one size fits all, but when it's understood and aligned with your goals, it can be one of the most powerful wealth tools that you have. Download our equity compensation white paper in the link below. And if this video helped, hit like and subscribe so that more high-income professionals can finally get control over their equity. And drop your questions in the comments, and also let me know what topic you'd like me to tackle next. Thanks for watching. I'm Dan Pascone, and I'll see you in the next video.